Hey everyone, it is Ian, and today we're going to be talking about finding inefficiencies and researching, furthermore onto, does this classify as an inefficiency? How do we look for these types of things? And lastly, placing a trade that captures this inefficiency. So you can kind of also say this is like finding a view that you have and finding something that expresses your view in the best way possible. Now, today we have a trade idea that is going to go coincide with this, and this is ticker symbol ICLN. This is iShares Clean Energy ETF, and basically, what's going on with this ETF as a whole is we're seeing some of the highest levels of IV that we have seen. Okay, and what I always like to look for in terms of is something inefficient is in terms of the volatility space is I'd like to see a significant gap between the implied volatility and the realized volatility. That is the number one thing that I like to look for. Because essentially what it means is there's a couple things. There's either a lot of uncertainty, there's a lot of fear, or the market is expecting something big to happen in the next 30 days. Okay? So with that being said, what I've noticed with regards to ICLN and the news as a whole is we are seeing a lot come out recently in terms of the clean energy markets, right? We have seen recently on Bloomberg, actually, they had an article posted yesterday, I believe, about Xi Jinping and basically saying that China is not going to rush their to clean energy. They're not just going to abandon ship on hydrocarbons. And what I think we're beginning to see with a lot of rumors and obviously everything that's going on with the natural gas markets and everything that's going on with the risks that Europe and honestly the United States as well have kind of put themselves in compromising some of their security, there is a lot of fear that we're going to see a decrease in, maybe we're going to see some pushing back of goals for climate, right? Climate objectives, right? Everyone knows about net zero 2050. And this fear, I think, is starting to stem into clean energy because think about it, right? If you're a clean energy company, and most of these clean energy companies rely on heavy government subsidization, right? Which is basically green bonds and things of that nature, right? The problem that they have is, well, if these countries like that are in the Paris Climate Accord begin to push back their climate objectives, then what this means is that this could cut into the overall performance and the overall profits and the overall expectations of companies that are in ICLN, like First Solar. Now, if we take a look at the price graph using the predicting alpha terminal and the volatility insights tab, we can see that, this fear has kind of been portrayed from a delta perspective over the past couple of weeks, and we've seen this also coincide with the recent rise in implied volatility over the past month or so. And obviously, this leads us to have an assumption that is confirmed that there is a negative correlation between the two. But getting back to the point about inefficiency, most inefficiencies, in my opinion, come from fear and uncertainty, right? A lot of these companies that are in this given basket of stocks, which is what an ETF is, report their earnings within the next month. Okay, a large portion of them do. Now the key is does this make sense? Like, does this rise, this exuberant rise and implied volatility versus realized volatility make sense? I think a rise in implied volatility as a whole makes sense, for the next 30 days, considering that the companies report earnings, like here. But what we can see is that it wasn't realized, right? It was not realized. And we're seeing an even higher implied volatility for the next 30 days this time around. This leads me to believe that there's additional fear and uncertainty baked in. Now, the way that we can kind of confirm this is with news, right? Confirming this with news. And that is what I mentioned earlier, right? Thanks to Xi Jinping, the rumors about, well, actually, this isn't rumor. This just got confirmed. But Germany is going to continue to run their nuclear reactors until 2023. You were seeing France talk about similar policies over there. You're talking about now the US, and there's a lot of demand from investors, including JP Morgan CEO Jamie Dimon, who came on publicly and basically said that we need energy security. We need to prioritize energy security. Now, I can't say the other details of what Jamie Dimon went into. You guys need to look that up for yourself. But as with regards to that, that is essentially what I think is happening here. There's a lot of fear, a lot of uncertainty. So how can we, really see if this is an inefficiency? Well, I think one of the better ways to see that is always with the relative value tab. And when we go down here, we can kind of see it first. This is implied volatility versus realized. We can see we have a persistent gap here, like we saw back in September of 2021. Um, if we go down here and look at the relative value, we've kind of seen this come in a bit over the past couple of days. This would have been great to get in last week. I still think it's optimal though, because markets really, and this is a topic we're going to talk a little bit more later, but essentially markets have really changed since the Fed said inflation is not transitory. And the Fed began to raise interest rates around this range, turning from 2021 to 2022. So I think that a lot of what we saw over here, I don't think we're going to see these types of numbers again. I think you're going to see something more of this. So this is in the upper end of its range in terms of its mean reversion pattern since, quote unquote, the market has kind of changed. So, with that being said, how will we maximize this, right? How are we going to place a trade that is going to capture this, quote unquote, inefficiency, which is essentially this, right? The markets appear to be afraid that you're going to see these countries that have invested literally trillions of dollars into clean energy suddenly pull the plug and walk away, or they're going to continue to just invest in hydrocarbons, right? I cannot imagine that they are going to pull the plug. Okay, it doesn't make sense. This just appears to just be fear, and this is usually when inefficiencies can arise because coming in with a logical perspective of, oh yeah, like Europe, who's invested, over 2-3 trillion dollars into green energy over the past 20 years, they're just going to completely pull the plug and abandon ship. It doesn't make sense, right? So how would we capture this? What's the best way? Well, if we're talking about implied volatility, right, and we're saying that that is what we think is expensive, and we think also that it's short-term implied volatility that is the most expensive. And what I mean by that is if we go down here and look at the term structure, we can kind of see this. We can see implied versus realized, on the longer dated compared to the historicals, really isn't much there. The more bang for your buck, so to speak, is in these shorter dated options. So with that being said, it's most likely that our inefficiency, the best place to capture it, is in shorter term. Okay? So how would we go about trading that? Well, if we open up, and I'm just going to use Thinkorswim in this example, but interactive brokers is fine, or whatever brokerage you use. Now, going here, what we can do is we can place a structure that captures this. And I think that one of the best structures we could put on to capture this is a 1 month straddle. So if we go here, we can see that these options are trading and expiring on November 18th, 2022, 31 days out, right? So by when this, video comes out tomorrow, on November 19th, 2022, it's going to be exactly 30 days until expiration. So this pretty much signifies the capture because we don't really have a view on direction. You could put a view on direction, but in this video, we're just going to be talking about volatility. You could put a view on direction, but from a volatility perspective, this is probably what you want the most because volatility and the exposure to implied volatility is highest. The Vega exposure is highest at the money. So we want to get as close to the money as possible. So that's 18 options or 19 options. Second, another reason that we want to have this on from this perspective is we're also at the highest exposure to gamma, which is the exposure to essentially realized volatility, how much this given stock actually moves. We're going to talk about that in further videos, but in essence, this captures it to the best of our ability. Now, maximizing our view, right? We know that our main view is that we think the volatility is overpriced here, right? But we also know from our analysis that we should expect, based off this negative correlation between implied volatility and the price of ICLN, we should expect that if implied volatility does come down or is not realized, which would most likely lead to shorter term IV, i.e. 30 DTE coming down, we should expect the stock price to rally a little bit, right? So instead of selling the 18 options, if you were really confident on this trade, it might be better to sell the 19. Now, if you wanted to hedge away some of that risk, as in, if the stock price continues to go down for a bit, right, implied volatility continues to come up, maybe you can hedge that by selling an 18 or a 17 strap. Because while you will lose money as implied volatility goes up, you will make money because essentially whatever option you're selling, let's say you're selling the 17 options, right? I'll actually throw on this example here so that way we can really signify this. If we sell the 17s, and let's say, it comes down here, right? Down to say 18, right? We are going to make a little bit of money off of delta because the call option, that 17 call, is beginning to lose value, intrinsic value as well, because it's in money. So, with that being said, just want to go over this, guys. I hope this kind of portrays a little bit about finding inefficiencies, finding uncertainties in the markets, how to validate this kind of uncertainty, weigh it and see, does it really make sense? Do we agree with the market? If we agree with the market, then there's no trade. But if we disagree with the market, then we have a trading opportunity. And of course, maximizing our view on that given inefficiency. So I hope you guys enjoyed this one. Let me know if you guys have any questions. That's all I have for today. Thanks, guys. Take care.